About 3.5 years ago, something happened, and I'm not even exactly sure where it came from, but I had this epiphany that told me I needed to start investing. I don't know if it was because I was unhappy at my job, or maybe because I was 26 at the time and I was just looking down the road into the future, or maybe a combination of the two, but something told me that I needed to find a way to start making money in my sleep, or else I was going to be working until I died. Now, this was right before the pandemic started, literally weeks before the big market plummet in March, and in February 2020, I opened an account with Robinhood and told myself that I was going to start putting money away every single week. Now, as I'm sure you can imagine, when I first started, I had no idea what I was doing. I started off with about $1,800 invested, and over the next handful of months, as I was getting my first consistent reps in with investing, the portfolio continued to grow, and the stocks I had became kind of a motley crew. In October of that year, which is when I started posting videos here on YouTube, I had a collection of 22 different stocks, most of which actually did pay a dividend with the exception of Dropbox, and I also had a portfolio on Charles Schwab that was started as a custodial account when I was younger, which, as you can see, was not at all dividend focused. In general, though, I'd say I was off to a pretty good start, but I was all over the place, and if I'm being honest, I had no idea why I was buying any of these stocks. But at the same time, how could I have? I was practically brand new to investing and started doing it without having had any experience. Everything I know about investing so far, I've had to learn on my own pretty much as I've gone along, and in hindsight, considering how deep I've gotten into this stuff, pursuing it for my formal education when I was going to college would have been a really good thing for me, and definitely would have come in handy, especially as a brand new investor just starting out. And with that in mind, I want to talk to you about today's video sponsor, Southern New Hampshire University. As someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said that I've never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value, apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio, utilize the rules and regulations for financial accounting and reporting in a global economy, generate financial records and financial statements for users in accordance with governing rules and regulations, and analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on the call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to find out what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. But anyway, getting back to it, it wasn't until this video here in January 2021 that I decided to go all in on dividend investing, almost an entire year after I got started. And upon putting things together for this video, I've got to say it was actually really interesting to go back and watch this from over 2 years ago to hear my reasoning behind wanting to transition strictly into dividend investing, and it was good to see that all of those same reasons I still stand by today. To share them with you here, I love dividend investing first and foremost because I am just crazy for that cash flow. I love getting that passive income for not doing anything, and there's nothing better than getting those dividend paychecks without having to lift a finger, and it makes it even sweeter to know that this income will just keep growing every single year. I also really appreciate the fact that dividends add an extra dimension to investing that makes it so you don't have to rely solely on capital appreciation to generate a return from the stocks in your portfolio. And because dividends do offer that cash flow, another one of my favorite things about this style of investing is that, in theory, you don't have to sell shares of these stocks down the road when you're ready to start living off your investments. If you do it right, you can keep compounding your wealth, and that wealth can be passed on to the generations that come after you, and I think that can be a really powerful and life-changing thing for your entire family. Now, while my reasoning for loving dividends is the same today as it was a couple of years ago, if I could go back to when I first started my portfolio, February 2020, I would have done things so much differently. Instead of spreading myself out across a ton of individual stocks and SPHD, which by the way I don't think is a great ETF, but anyway, instead of that, I would have constructed my portfolio to look something more like this one here. This portfolio only has 4 different holdings as opposed to the 22 that I was holding when I first got started, but here we've got Bank of America, which is the bank that I personally use and have for years. We have Procter & Gamble, Tide laundry detergent, Crest toothpaste, Dawn dish soap, all things I'm very familiar with and use around the house. And then we have Starbucks, another another company that I am very familiar with. I'm a frequent Starbucks customer, so this is one that I understand very well. And based on how this is diversified, I would have only put about 10% into each of these 3 holdings, and then would have put the other 70% into something like SCHD. Something like this would have been so much easier to manage than the 22 holdings that I was rocking with when I first started out, and it would have been a great starting point that would have given me the best of all worlds, really, and as an investor, it would have helped me learn how to walk before I could run. With 70% of this portfolio in SCHD, I would have had a well-diversified safety net here that would have paid a nice growing dividend, and then I could have used the 3 individual stocks here that I'm pretty familiar with to learn how to actually research these companies. Plus, it would have made it a little bit more exciting for me than just investing in something like SCHD or VU. Now, some might disagree with this approach. Some people might think that you should just go all in on ETFs as a beginner investor when you're first starting out. And actually, some people think that you shouldn't stray from ETFs at any point. And I don't disagree with that at all. I actually think that's pretty sound advice if you're looking for the easiest, most hands-off way to invest possible. But if owning individual stocks and learning how to do the research on them sounds at all interesting to you, as it did for me, then I don't think this would be a bad way to go about it. And actually, if I would have stuck with a portfolio like this from the time I started until now, I actually would have done pretty decent. If I would have started with the same $1,800 or so that I started out with in February 2022 and just invested $100 every single week, the final balance would be $22,634, which does underperform the S&P by a little bit. It's pretty dang close, but there's about a $1,300 spread between the two. And looking at the annualized returns, the spread does look a little bit more severe. I mean, 11.3% for the S&P in this time period compared to 8.77% for my little sample portfolio here, but still a near 9% return is not bad. But then again, on the other hand, I still would have been better off with my actual portfolio, seeing as it had an annualized return of about 10% in the same time period. So about 1.25% higher than the other portfolio we just looked at, which for the most part, I'm just gonna chalk up to luck on my part. I've definitely learned a lot, and I've come a long way as an investor over these last few years, but I've also definitely been blessed by the investing gods and the dividend snowball effect, which I'm telling you about in this next video right over here. Your journey as a dividend investor does start off slow, but with each reinvestment, your dividend snowball grows bigger and bigger and bigger. And if you want to see just how big your portfolio can grow with the help of the dividend snowball effect, then click right over here to check it out, and I'll see you in the next one.